the session.
Sure.
So as we were speaking about the liquidity position of a company, and we have considered current ratio as one of the benchmarks or standards to judge the liquidity of a liquidity position of a company. The next ratio what we are considering here is quick ratio. This quick ratio also is a very handy tool or a very important ratio to judge the liquidity position of a company. The formula for quick ratio is quick assets upon current liabilities, and quick assets are nothing but all the current assets except inventory and prepaid expenses. This two you shouldn't be taking to calculate the quick assets, okay? Or else I'll write down the formula as well. Quick assets is equal to total of current assets minus inventory and prepaid expenses. Fine, is it okay?
Okay.
Now, we should not be kind of only blindly following the formulas. We should also know the reason why we are not considering inventory as a part of quick asset. That is more important. See, CFA is nothing but when it comes to CFA course, it's all about questions. It's not getting convinced. Why is the word always, should be on our like on our like on our front point, in the sense it should always be in our mouth. Why it is so like that? Why we are not taking inventory? So
Okay.
the point here is, see, quick assets. The difference between quick assets and current assets is, current assets are such assets which should give you economic benefits within 1 year span of time. Okay. But quick assets should give you economic benefits within half year or in 6 months. That would be more easier to understand. So some assets which can give you economic benefits within 6 months can be said as quick assets. Some assets which give you economic benefits within a year can be said as current assets. Okay.
Okay.
So as the difference is very clearly understood, we should remove all those assets from the total of current assets, which would take more than 1 year to give us economic benefit, more than 6 months to give economic benefits, or would be converted into cash for and would take more than 6 months to convert into cash. You only realize the economic benefits when the assets get converted into cash, right?
Mm-hmm.
You get the benefits in your hands. So the
Hmm.
point is, from the total of current assets, we will remove all those current assets which would take more than 6 months to get converted into cash, or which would give economic benefits taking more time than 6 months. So why inventory we are targeting? See, when we take all the current assets, inventory happens to be the most tangible nature current asset, correct?
Yes.
Why it is called tangible nature current asset? Because
Because we can see the stock
we can see
available.
the inventory, we can touch it, we can feel it, it has physical substance.
Hmm.
Okay, so we
Okay.
have to remove those assets from the category of total current assets which are most tangible nature current asset, because something typical about tangible assets is it will take longer time to convert into cash or give economic benefits. If you take a land, you cannot expect short-term gains. You should hold it for a long
Hmm.
period of time to get very good gains from it. Am I right?
Yes.
And land would not be something, if you buy today and if you want to sell it like in 2 days or 3 days or 1 week or 1 month, it is not going to happen. It's going to take good amount of time for you to convert that land into cash. That's the reason
Hmm.
why those are called non-monetary assets or non-liquid assets. Okay. Now we are only taking more liquid assets and less liquid assets we are removing from the category. So, and
I'm sorry.
prepaid
Can you just repeat what you just said? Because your voice got cut. I told you that my internet connection is little bad.
Okay, I said land. I said
Okay.
land is kind of a asset which is non-monetary asset or illiquid asset.
Okay. Okay.
So non-monetary assets are some assets. Why they are called non-monetary assets? Because they cannot be converted into cash quickly.
Immediately.
Why certain assets are called as illiquid assets? Because they cannot be converted into cash very quickly.
Mm.
So we will. So here the agenda is we want to take only those current assets which can be converted into cash quickly. So we will remove those current assets which will not be converted into cash quickly. That is inventory. And prepaid
Okay.
expense also we want to remove. Why? Because already we have paid the money for certain services which we are going to take in the future. And prepaid expense is not kind of a current asset whereby you are going to get some cash to pay some liabilities. Okay. So we remove that also from the category. So now very clearly there refinement has been done. Remove the tangible nature current assets and will take only those current assets which can give economic benefits within 6 months of time. Now note 1:1 is a ideal quick ratio.
Quick ratio.
Quick
Sorry.
ratio or acid test ratio. Yeah. Why it is called as acid test ratio? Because if you want to test something, something chemically, acid test is the test which can give you quick answers. That's the reason why acid test ratio, because something which can give answers to you quickly is what you are considering here. Something which can give you quick benefits is what you are considering here. Those assets only you are considering here. So acid test ratio. 1:1 is the ideal ratio. You can understand why, because major portion of current asset has been removed, because inventory happens to be such a current asset which has a major portion in the total current assets. So when we remove that, major assets have been removed. So now the assets value has decreased, and now the assets what you have and the liabilities what you have should be equal here. How much ever you need to pay, that much ever funds you should have in 6 months of time. I know
Okay.
when the year end comes, you are building more assets and it becomes 2:1 becomes the ideal ratio. But in 6 months of time, you should always have how much you are supposed to pay, that much resources you should have. Then we can say that company's liquidity position is strong. Okay.
Okay.
Hello.
Yeah. Yeah.
I'm saying if you are supposed to pay one rupee to someone, 1 rupee resources you should have. And those resources are the resources which are more liquid. Okay. Now,
Okay.
next is cash ratio. Cash in hand, cash at bank, short term, temporary investments, whole divide by current liabilities. Okay. So what we are
Okay.
doing here, we are taking
And
only
short term?
those short term temporary investments.
Temporary investment.
Yes. Which can be immediately converted into cash. You have stocks of some company, you have invested for temporary basis, you don't want to hold it for longer period of time. You can immediately convert into cash when you get the economic benefits, and it will take 2 days for you to get your money back in your account, right?
Okay. Okay.
And these are the ones which are immediate cash, which you have in your hands, which you
All.
can use. Sorry.
No. 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 Continue.
Okay. Any doubts? You can ask me, no
No.
problem.
No. 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 Till now I'm clear. I'm clear.
Okay. Okay. So why are we taking this ratio? I'll give you I'll give you one example to understand. Case 1, case 2.
Okay.
Let's say you want to buy a flat apartment. Okay. The cost is 50 lakhs. 10% is the down payment. 10% happens to
Okay.
be, sorry,
5.
20%. In India, we don't have 10%. So 10 lakhs in other countries like Europe or Australia or UK, you have 5% as down payment.
Okay.
That is the reason why when we see any of our relatives have got settled in Australia, UK, or they immediately buy an apartment. What it doesn't take, they'll take villas actually. It doesn't take much of the time for them to buy,
Yes.
because outskirts are easy and downtown area is very costly. and rentals are very costly, and the EMIs what you're going to pay is very reasonable. So they take like that.
Okay.
In India, if you want to settle, it's very tough. In abroad, you can settle very sooner. Just you need to get one job. That's it. So 50 lakhs is the down pay is the apartment cost. 20% is the down payment. 10 lakhs you have made the down payment. Now you need to pay 40 lakhs and you have got 30 years span of time. This is if you, that's the reason we say when you are like study well, get a good package, and in young age you can buy your own dream house. Correct?
Yes.
That's the reason we say study well, study well. The entire time the parents are back of us. So 30 years span you get to make the payments. 40 lakhs you need to pay. You can pay easily in 30 years. No rush, no pressure, nothing. Okay.
Yes.
Case 1, you have 2 lakhs of cash in your hand. Case 2, you have 20 lakhs of cash in your hand. Which case you feel yourself much more safer? Case 1 or case 2? Sorry. Hello.
Hello.
Akhila,
Am I audible?
yeah, now audible. There was a lot of disturbance. Yeah, tell me, please.
Sorry.
Connection issues, huh?
Yeah. My network issue for 2 more days.
No worries. You are comfortable. I'm comfortable. Yeah, tell me.
So I guess in both the cases.
How both the cases? Okay. Here you got some emergency and you want 5 lakhs immediately. Here also emergency 5 lakhs. In which case you are able to fulfill your emergency?
20 lakhs. The second case.
Yeah.
20 lakhs. Yeah.
So now again a question you'll ask, sir, if that is the case, then why didn't he make down payment and why is he paying more interest? See, we tell people, don't go with old school thoughts. When like some people who are old school, they'll say, don't take loans, don't buy property on loans. So how many people you have seen have become richer without taking loan and buying the properties? Very less people, because until and unless you don't take risk, you won't become richer. Risk you in your life you have to take a risk. Okay, no, I'll just do a job. No worries. There are many people who are earning in crores, but they are doing a business because they have taken ultimate risk, lot of risk in their lives. Correct? So more the risk you take, more the returns you will expect. And the same case, you should take loans when you are eligible and you are getting that loan. You should take, because you know Ambanis have a lot of money and you know a lot of a very high net worth, but still they also take loans for their companies. So loans, if you take, if you're getting loan, you're eligible, take that, no worries. And in case of home loan, go for it. Why? See, if you have money, no worries. This 20 lakhs, I will do one thing. 5 lakhs, I'll keep cash reserves. 15 lakhs, I'll put into SIPs and mutual funds. And that SIPs and mutual funds will not be lock-in ones. I can immediately convert them into cash. Whenever I want, in 2 days, I'll get the money in my account. It will be created in my account. Okay. Now, in this way, I'm just going for a very good combination. I'm getting good returns from this. See, that's what I'm giving a suggestion. If you have cash, don't keep it. You keep very less cash with you and maximum money put into SIPs and mutual funds. At least there will be growth in the money. Okay, to give you 15%, 16%, I am getting 45 to 48% in my SIP. My wife is getting 59% in her funds. And small cap can give you even more than that. That's what. Now, and now point here, what I'm trying to prove to you is, I have 20 lakhs with me, and I'm saying that take home loans, because what happens? Let's say you are paying 10,000 as a interest. This interest you can claim as deduction also. See, if 1 lakh is your taxable income, 10,000 is the interest amount that you are deducting or reducing from your taxable income. 90,000, because this is an exemption what government gives you. They'll give you exemption for this. You can reduce this from your taxable income and pay taxes on the net income. So my taxes would be on 90,000. 30% of 90,000 is 27,000. Otherwise, how much cash I would have, how much tax I would have paid if no deduction on 1 lakh? 30,000. 30%. 30,000. Correct or wrong? Hello? Hello?
Yes. Yes, yes.
Yeah. See, you know this income tax, right? So 1 lakh is your taxable income. 10,000 interest you are claiming as deductions or exemption, qualified savings, ATC, section ATC. I don't have that much idea of the Indian taxation. Okay, I don't deal with that. 90,000 is your net income on which you have to pay taxes to the government, and that happens to be 27,000. Otherwise, you have to pay 30,000. So here you are saving how much? Cash savings is how much?
3,000.
Yes, 3,000. So now if I say 10,000 was the interest payment for me, 3,000 is the cash savings for me. Net in net, my cost is how much? 7,000, right? So it's only 7% is what costing you for interest. Why to worry? Such cheaper interest you won't get for any other loans. Only housing loan can give you that facility, because the housing loan interest, whoever a person buys a house and he is paying an interest can claim deduction for that interest from his taxable income. So that's the reason why I would go for full home loan if I get. Okay. And now coming back to the case. Case 1, case 2. So I have 2 lakhs, I have 20 lakhs. And the question what you had in your mind, we can pay a down payment to pay this 40 lakh loan, more 10 lakhs we would have paid the down payment, and that would have reduced our loan by 10 lakhs, and 30 lakhs only would have been the outstanding amount. No, I'm taking a loan because I'm getting good benefits over there. I'm getting an exemption for interest what I'm paying. Okay, and this fund what I have, so now you'll be having a idea. Now you'll be having a doubt in your mind, sir, 40 lakhs is my home loan amount, right? I need to pay this and it's a very big burden. I'll tell you, your EMI happens to be, let's say you have taken a loan for 30 years and and the rate of interest is 10%. Your EMI is 30,000, let's say. Okay, because on 1 lakh, 1,000 rupees is what bank is charging to you. Okay. No, not 1,000. On 1 lakh, bank is charging you 700 rupees, let's say 750 rupees. How much? 750. Just multiply 40 into 750. How much? Okay. 750, 700 plus 50 into 40 lakhs loan. 7 fours are 28. 28 lakhs plus 5 fours are 20. 2 lakhs. 30,000. So 30,000 is my EMI amount, and I am telling you every month you put 20 lakh rupees of money in your SIP account. I'll tell you what is going to happen for 20 years or 10 years. Is everyone following? Hello?
Yes, sir.
Yeah. Akila, are you following? There is a problem with your network, Akila. Serious problem, I think. See, I'm putting 20,000 per month in my SIP account. Okay, fine. 20,000 rupees I'm putting in my SIP account. My expected returns are 14%. And I've taken 10 years. Now you see. I've invested 24 lakhs. I've got a return of 28 lakhs. And 52 lakhs is the expected value. I can easily pay off this Home loan, see here, 40 lakhs rupees home loan I can easily pay off, and I'll still be having 12 lakh rupees of corpus with me or funds with me. So that is what people should do, not worry about loans, but should try to generate more returns. So if I take a SIP, I'm getting 14% returns. For me, the cost for interest is 7% after considering deduction. So extra 7% I'm making here in case of like here I'm making extra 7% returns. That makes sense, right? So case 1, case 2, 2 lakh rupees. If I have, I'm not safe. Why? Because 2 lakh rupees is very less amount to keep yourself safe and secure. 20 lakhs is a very good amount. You can hold it, okay, and you can pay the home loan easily by taking an SIP, okay. And if you always maintain 20 lakh rupees of cash with you, you're always very safe when compared to 2 lakh rupees cash, because your loan happens to be 40 lakhs and you are maintaining 50% of cash, which you can easily make use in the future to make the loan payments or repayments. So what we have learned here is, if you have a liability of 40 lakhs, if you have cash reserves of 20 lakhs with you today, you have 50% of the money for the obligation which you have for future. So that means ideal cash ratio is 0.50:1. That means if my liability is $1, I should always have 50 cents of cash with me. Okay, then I can say I have enough liquid funds to settle my obligation in the future. I'm speaking only about the liquid funds. That means I'm speaking only about the cash. I'm not saying that you shouldn't have other kind of resources. You may have land, you may have buildings, you may have other assets, but all those will take a lot of time for you to convert into cash. For example, there is Mr. X who is going on a highway, national highway, and there is and he is going in his car. There is a puncture in his car or some problem, some repair in his car, and he has to stop the car beside the road. And there's a mechanic who is doing the mechanic who is just trying to service this car. And when the mechanic asks Mr. X about the payment details, sir, you have to pay me 80 rupees. Mr. X is someone who is holding credit cards, who is saying that I have land, building, property, etc. But it doesn't matter. What matters is he should have liquid cash on spot with him for to settle any of his petty obligations. So in the same way, cash is a different kind of a, cash give you a different kind of confidence. If you have liquid cash, always you feel very much confident because it can be utilized for any speculative activities as well. If you get good offer, you can use that cash, or else whenever you have some kind of emergency, only cash can help you. Other assets will take time to convert into cash. Okay, but smartly what we can do, for 20 lakhs, 5 lakhs we can hold, 15 lakhs we can divide into SIPs and mutual funds. That is what is my planning to you, which I'm giving to you. Okay, so these are the three ratios which we covered under the liquidity part. Okay, you can see this cash ratio, you can make a note of it. We'll move forward. Okay, now let's understand the next set of ratios, that is turnover ratios. Everyone, ideal ratio for cash is, yeah, 0.50:1. Just a second, I'll write it here. Zero 0.50:1. Okay, got it, Akila? Yeah. So just do one thing. You just settle your connection. I'll be back in 5 minutes. Okay, I'm calling once again.